Hello investors, welcome back to this channel. I hope you are doing well. So in today's video, I'm going to tell you how you can grow your investments to crores without needing a finance background. So in previous video, I had talked about starting your investment journey by investing in an index fund. So in today's video, I am going to show you how you can choose an index fund for yourself and start your investment journey. So don't worry, it will only take 10 to 15 minutes and you don't need to be a finance expert for this. So let's start the video and don't forget to hit the like button and subscribe to this channel. Let's start the video. So first, let's try to understand what are index funds. So index funds are like a mutual funds or ETFs, which are designed to mimic a specific stock market indexes. So like in India, we have Nifty 50 and Sensex. In Nifty 50, we have 50 different companies from different industries. Like we have Unilever from FMCG, we have HDFC Bank from banking industries, we have TCS from IT industry. Like this, we have different indices which represent a particular market segment. So these index funds tries to replicate the performance of an actual indices. For example, if Nifty 50 goes up, then index fund, which is replicating Nifty 50, will also go up and vice versa. So there are few reasons why index funds are popular. So the first one is investing in an index fund is really simple. So you know that your money is getting invested in these 50 companies. So you can keep an eye on these 50 companies easily. You can follow the news of these 50 companies. So the second reason is low expense ratio. In index fund, they will charge you less expense ratio as compared to an active fund. So in active fund, they need to create a portfolio. They need to analyze the industries and all those things. Unlike in index fund, they just need to replicate the index and invest your money. So that is the second point. Third point is any beginner and experienced investor can start their investment journey by investing in an index fund. So the third thing which we are going to discuss is minimum duration and return expectations. So just remember that whenever you are going to invest in the stock market, you have to stay invested for more than 3 to 5 years. You can't just invest for 1 to 2 years or less than 3 years. I will show you the chart of Nifty. It will help you to understand better. So this is the chart of Nifty since 2000. As you can see here, the value of Nifty in the year 2000 was around 1592.2. So what is the value now after 23 years? The value of Nifty is around 19,428.3, right? So this is a nearly 19 times jump in the price of Nifty in 23 years. So let's assume that you invested in Nifty around 2015 May. So the price of Nifty at that time was around 8331.95, right? So you invested for 1 year. After 1 year, you saw that the value of Nifty is exactly like the previous year. So now also it is trading around 8541.4. So you did not get much returns. So that's why let's assume that now you stayed invested for nearly 4 years, right? So what is the value of Nifty now? 11,900. Okay, aspas. So you saw that in 4 years you got a return of more than 20 to 30%. So that's why you have to stay invested for more than 3 to 5 years. Like this index funds can give you an annualized return of 10 to 12%. This is a pre-tax return. Moving on to the part two, we will select an index fund based on these criteria. We will see what is the expense ratio of an index fund, what is the tracking error, if the fund has a direct or regular plan, what is the portfolio of the fund, what is the minimum investment amount which you need to start your investment. After that, we will see fund company reputation. We will also see liquidity and what is the size of the fund they are managing. And in the end, we will see fund manager and management style. So till now, as we know that index funds are mimicking the performance of the indices. So we can ignore the first 3 points for the time being, which are fund manager and management style, fund company reputation, and funds portfolio. So let's see what is tracking error and all those things. So I have visited Coin website by Zerodha. As you can see, I have selected UTI and Nifty 50 index fund. So this is a direct growth plan. Just below that, you can see CHER and current NAV. Current NAV means for the simplicity purpose, just assume that this is the share price of this index fund. After that, we have CAGR. So if you want to know how much returns this fund has given for a particular period of time, so you can check this. I have selected 5 years. So try to select more than 4 to 5 years because you know that stock market is volatile. After that, we have minimum investment. So you can't invest less than 5,000 rupees. So, and after that, we have AUM, which means asset under management. So they are currently managing 11,585 crores of rupees. After that, we have exit load. So assume that you were in an emergency and you want to withdraw your investment. So the certain fund houses will charge you some money. So that is called exit load. After that, we have expense ratio. Expense ratio in the sense the fund houses will charge you some money to manage your investment. They have given the name of the fund manager and the company. So this is UTI. and they have also given the risk. So just below that, you can see the sectors in which your money will get allocated. So we have financials, we have IT, we have energy, we have consumer staples, and all those things. So after that, they have given company names, they have given a scheme document. So now let's compare the index funds. So now let's try to compare these three index funds. First, we have BSE Sensex fund. After that, we have Nifty 50 index fund. After that, we have Nifty 50 plan. So when we compare these three funds, as you can see that HDFC S&P BSE Sensex fund has given more return as compared to other two index funds. So the one more thing which you need to notice, during the crash of Corona, this fund has fallen less as compared to other two funds. So what is the main objective of an investor? As an investor, you should always try to get more returns with less risk. So this fund has given more returns as compared to other two indices with less risk, right? So when I scroll down, you can see the minimum investment amount. The S&P BSE Sensex fund needs a less minimum investment amount as compared to the UTI Nifty 50 index fund. So after that, you can see dividend type. It is better to choose a growth plan always. So after that, you can see this is a index fund. So the AUM which they have given is 5,000 crores, 11,000 crores, and 8,000 crores. So you should always go for that index fund where the AUM is huge, because when you want to sell your investment, you need someone to buy from you, right? So they have given CAGR returns for 1 year, 2 year, and 3 years. So for 3 years, the UTI Nifty 50 has given more returns as compared to other two index funds. So they have also given exit load. So in this case, a UTI does not charge you exit load, and other two HDFC funds charges you 0.25%. Now, as we have finished step 1 and step 2, now we need to know how you are going to invest our money. So we have two options now. One is lump sum investment, another one is SIP. Lump sum means investing all your money at once. SIP means you can invest your money systematically. Either you can invest weekly, quarterly, or monthly. Monthly will be the best option. You can invest on the first date of every month. So it is always better to go for a systematic investment plan, which is SIP, because nobody knows that if the market is overvalued or undervalued. Some people think that they can time the market. If the market is undervalued, they can start their lump sum investment, something like that. So it's always better to simplify the investment process. So let's go for SIP and let's calculate the returns. So this is the SIP calculator by Grow. They have given two options. One is SIP and another one is lump sum. Let's go for SIP, and I have set the monthly investment as 1,000 rupees and expected return as 12%. And in the 40-year time period, you can see that the estimated return will grow up to 1 crore 14 lakh. So now let's go for lump sum and calculate the returns. I have set the total investment as 2 lakh and expected return as 12% for the 40-year period. As you can see, my amount will grow up to 1 crore 86 lakh 10,194. So this is the expectation from the market. So I'm assuming that the Indian economy will grow steadily for a longer period of time. So I'm not accounting for any micro or macroeconomic risks which can arise due to uncertain events. So that is the conclusion, because whenever you are investing in something, you need to believe in that process. So then only you can get more returns. So now let's talk about risks involved in investing in an index fund. So till now, you know that when you invest in an index fund, your money will be distributed in various companies like Reliance, TCS, Infosys, and all these companies. So if these companies goes out of business, then there are chances that you will lose your money. So that is the risk which you will be taking by investing in an index fund. That's it for today's video. So that was the entire process of choosing an index fund and starting your investment journey. If you found this information valuable, don't forget to hit the like button and subscribe to this channel. Also share this video to maximum people so that they can start their investment journey properly. See you next week. Bye.